Paul's very well known throughout the ag industry. He speaks all over, writes a Substack column as well. But I've just got a little something typed up here. I'll just read it. So Paul's a CPA. He's a farm strategist. He's one of really, truly, I've heard him speak multiple times. He's one of the most truly trusted voices in agriculture, kind of a no BS kind of guy. And and his primarily he authors the Farm CPA report, which is a blog,
Yep.
right? You're still
Yep.
doing that?
Yeah. Oh, yeah.
Uh,
Yeah. Yeah. Posted this morning. So, yeah.
Yeah, and he does podcasts way better than I do for top producers. So he's a much more seasoned podcaster. I'm new to this whole bit and trying to learn from greats like himself. He provides tax education services for CPAs, so he's training the CPA industry and other tax preparers. He's recognized as a national speaker, hard for me to say, on topics related to farm businesses, incomes, estate tax planning, farm service agency planning, just kind of that whole universe like we were talking about. Paul's seen a lot. He grew up on a farm in the state of Washington, right, Paul?
Yep.
Yep,
Yep.
yep.
Southeastern Washington, nice steep country, 40, 50, 60% slope. So,
Yeah,
yeah.
yeah. So what did you raise out there?
Raised wheat. We raised barley a little bit, dry peas, green peas, chickpeas now,
Yep,
which is garbanzo beans or hummus. If you make
yep,
hummus, it's out of
yep,
chickpeas. So,
yep,
yeah, that's what we raise now.
yep. Still have a farm out there?
Yep. Yeah, I have I own about 250 acres outright, and then I have an interest in another 1,000. So,
Nice.
but yeah,
Yeah, yeah.
definitely. And then own my little farm in Iowa and my bigger farm down in Southwest Missouri.
Very good. So you still get your butt in a tractor once in a while.
More the combine. I'll do the
Or the
tractor,
combine.
but
Okay.
yeah,
Yeah.
combine therapy is I enjoy that more than tractor therapy. So
Yeah. That's great. Yeah, I guess definitely looking out the windshield of a combine certainly does allow you to have a lot of time to reflect. And
yeah,
so, we can keep this conversation, we can take this conversation anywhere, Paul. What I was really thinking we could do is really, dive into topics around landowners, growers,
yep,
you
yep,
know, um, and looking at it through your lens as a CPA, as an advisor, what you're seeing in the industry. So it's really awesome to have you here. And again, I want this to be an open conversation. If you think there's something that's extremely valuable that the people that are on the podcast and listening today, or maybe listening in the future on a recording, please bring it up.
yep,
We need to talk about this because we like to keep it. We're going to keep it about 45 minutes, keep it nice
yep.
and short. So what we thought we would do today is kind of like an executive summary is we'll um, ask you why leases matter, right? And any trends that you're seeing out there that, are people in industry need to know about. Maybe I know I've seen some work that you've done on some of your blogs and whatnot around cash versus crop share. What are the tax benefits? We'll dive into that a little bit. Any other tax considerations for
Yep.
landowners, legacy considerations. It's huge, right? I mean, as we see the population, there's two things that are going on simultaneously. We've got land ownership, and that transition of land ownership in concert with farms transitioning as well. So it's a lot of these disruptors that are going on, and I know people are talking about it feels like that people are talking about the farm transition, farmers getting older and those sort of things. But this land transition piece that to keep the land in the control, whether it be lease land or, like what we deal with, those are issues that I think, that need to be brought up to the top
Yep.
as well, right? And really
Yep.
talked
Yep.
about.
Yep.
And then we'll just talk about, technology and all those sort of things. Um, so I'm going to jump right into this. And if you have a question, please put it in the chat. I'll try to monitor it the best I can. And,
Yep.
uh, and maybe Paul can look at it too and see if there's anything in there. I know we have some folks from Oaken on here as well. But so anyway, so why leases matter, okay? And Paul, you've been educating the agricultural community for years, right? And that wealth of knowledge is so broad and needs to be shared. Um, what why do you why do leases matter looking through a CPA lens, to you, and should it matter for, individuals? Because we see all kinds of leases in Oakland. We're still seeing quite a few handshake agreements, and we've
Yeah,
had,
yeah.
legal on here talking about, legal ag experts talking about, why it's important to document. But, from a CPA perspective, why do you think that, they need a lease, or why do
Well,
leases matter from a
there's
CPA?
certainly you sort of hinted a little bit at the legal standpoint. Again, I'm not an attorney, but
Right.
certainly if we're dealing with a lease, then we have parameters that says, okay, the tenant's got responsibilities in writing, the landlord's got responsibilities in writing. So that's one reason why leases do matter. From a tax standpoint, if we're talking about a crop share lease, it actually needs to be in writing in order for them to be able to take advantage of farm income averaging, which can be
Yep.
very powerful for crop share farmers. If that lease is not in writing, then technically you're not allowed to take advantage of farm income averaging. Now, I'm not saying that taxpayers don't do that anyway, but
Right.
from
Right.
the as far as the Internal Revenue Code, you have to do it that way.
Do you have to have the document itself, Paul, as well, to show?
Well, you need to have it in writing. You don't have to attach it to the tax return.
Okay.
It just needs to
Okay.
be a signed lease.
Okay.
And how many times have I seen a lease where it wasn't even signed? I've seen that multiple times. So if you have an unsigned lease, you don't have a lease,
Right.
from a legal standpoint. So and then I think and we'll probably start diving into the types of leases, whether we're talking a cash lease, whether we're talking crop share, whether we're
Yep.
talking a flex lease.
Yep.
But it is interesting in parts of the country where cash leases are king. Like if I go to the Midwest, typically cash leases are king. If
Yep.
you're out in my neck of the woods where I grew up, now I live in Colorado, but out in my neck of the woods, southeastern Washington state where I grew up, crop share is, I won't say it's not 100%. It used to be close to 100%. It's probably 80, 85, 90%. Although cash leases are starting to come up a little bit now. And then you have various flavors of crop share leases. You have what I call a true crop share, which is what I have on my farm in Iowa and Missouri. Is I'm 50-50. I get 50% of the crop. I pay 50% of most of the major inputs, seed, fertilizer, and chemicals. Now, in Washington State or other areas, maybe in the wheat areas, you might have a 60-40, you might have
Right.
a 2/3, 1/3, you might have an 80-20. Legumes are typically 80-20, winter wheat 60-40, spring wheat is 2/3, 1/3, and various combinations thereof.
Yep.
And that's sharing in the expenses, whereas other landlords don't want to really have to write a check for various expenses. So there, instead of a 60-40, they might have a 70-30, where they only get 30% of the crop, but they don't have to pay any of the expenses. So
Right.
it just depends on the situation.
Now, is there any benefits from a tax perspective of any different percentages that you see from, trends standpoint, or what you see in the industry? I
Yeah,
know you said yeah.
from a tax standpoint, a crop share, I guess you can make an argument if you're concerned about Section 199 Cap A, and that's that 20% deduction that we have for crop share landlords, for
Yep.
farmers, and for certain cash rental landlords. But if you really want to bulletproof your lease, the more that you're sharing in those expenses, the more that you can prove to the IRS that you're a traded business.
Yes.
Now, I typically find if you're sharing in the crop and you're marketing the crop and you're doing all that, and you got because you're dealing with USDA, because you got to deal with getting your share of the payments, you're going to have crop insurance likely. That's more than sufficient to rise to the level of a trader business where you can take advantage of the Section 199 Cap A deduction. If you're only a cash rental landlord, you get one check and you write a check for property taxes, might be a little more difficult. Now, I tend to err on the side of being in favor of the taxpayer when I can, but But if that was all you had, the IRS, if you were to get audited, would likely argue that you don't rise to the level of trade or business.
Okay. Okay. So on the 199A, right? And kind of, so let's say there's someone, like myself that doesn't, I'm looking at a cash rent lease, I'm looking at a crop share lease, and I want to take advantage of that. What are you, and you talked to it, but I want to kind of spell it out, drive it out a little bit. What are the benefits to the, say, landowner moving to a cash share lease? Kind of the top
Yeah,
five,
so
top three
the
things.
benefit, if a cash lease doesn't rise to the level of trade or business, you're not going to get that extra 20% deduction.
Gotcha.
If and whereas a crop share almost automatically rises to the level of a trade or business where you're going to get that 20% tax deduction. Now some crop shares, the tenant farmer sells the crop, does all the marketing,
Right.
handles everything with USDA, handles everything, and
Yep.
at the end of the year, they give you a net check. That really, probably from a trade or business standpoint, is still the same as a cash lease.
Right.
So you want to have involvement. Now, on the cash lease side, if you're involved with the tenant farmer and you're saying, hey, I want to be involved. I want to know exactly what crop you're planting. I want to have some involvement.
Yep.
You don't have to be self-employed to get the 20% deduction. You just have to have enough involvement to reach to that level. And there is no written test. There's no written parameters to say what level is sufficient enough to get you there. But it's not a high bar, it's a fairly low bar, but it is a bar that you need to get over.
Gotcha. Gotcha. Okay. Very good. Now, so on that, so is there any downsides? I mean, we talked about the benefit. Is there any downside to from that contractual agreement for those individuals, right? What's the downside if I go cash? I guess writing the checks probably one of the biggest, right? Having to have the
Well,
sufficient
yeah.
funds to meet those input
Yeah.
needs, right? But what other things?
Well, the downside compared to a cash lease, the nice thing about a cash lease, you know exactly what you're going to make.
Hmm.
As long as they pay
Yep.
that check, let's say it's $300 an acre in rent, you're going to make $300. On a crop share, you're going to have a good idea what your inputs are, plus or minus, so you can factor that into your budget because those are typically due up front. But then you got to wait for harvest. You don't know what the yield's going to be.
Yep.
You're going to get the yield, and then you're going to get your share, and then you got to market it. And right now, we actually have a fairly, matter of fact, I just got confirmation that I sold some wheat in Southwest Missouri for 605. So I'm fairly happy about
Okay.
that.
All
Now
right.
I sold wheat back in 2022 for $12.45. So that's hey, if it's $12.45, I'm going to do much better than a cash rental landlord.
Right.
Much better.
Exactly. Yeah, absolutely.
If it's $5 what it was last year, I might do worse than a cash rental landlord. But I typically see over time, I typically see a cash rental landlord, his or her return compared to a crop share landlord, at least dealing with I'm going to look at my history.
Right.
Overall, my return as a cat or crop rental landlord has been better than my return as a cash rent landlord. Now that's
Okay.
over time,
Right.
because my good times are going to be substantially higher than the cash rental landlord, and my bad times are going to be lower, but I don't have all the fixed overhead that the tenant does.
Yeah.
I don't have to buy all that machinery. I don't have any operating debt. I don't finance any of my inputs. I have cash for that. I don't have to worry about labor. I
Yep.
don't have to worry about all these other costs. So over time, I typically see in that difference. I can tell you on a couple of my farms, my difference crop share versus cash rent over the last few years. It's let's say my cash rent return might have been 4%. My crop share rent return's probably been closer to 8 or 9%. So
Yeah.
it's better. Now,
Yeah.
if you're a rice farmer in Arkansas or a rice landlord in Arkansas,
Yep.
Yeah, maybe it's a little bit different, but and partly I have pretty good bases. You know, my bases on my ground in Missouri, because that's I have 360 irrigated acres down there. I get 50 cents over on corn and
Yep.
soybean and wheat. I'm pretty close. I'm maybe a little bit under, but I'm pretty close. So so that helps out too, compared to if I was owning ground in North Dakota or
Yep.
Minnesota, where the bases might be 50 cents a buck under
Yep.
future.
Yeah. No, that's good to know because I mean I think people are always trying to weigh those. We hear that all the time when people are, like, well, here's why I went with a cash rent. Here's what, a lot of times what we've seen, if there's lots of entities, lots of owners of that land, right? We're seeing things move from one to two individuals owning the land to now three, four, five individuals,
Yep.
and they kind of want to see the, kind of hit the easy button, for lack of, that's Ron's term. That's not anybody else's. Nobody's put that in my mind, but but they just want to see it, either what we're seeing a lot of are flex type
Yeah. Yep.
agreements or
Yep.
a cash rent agreement. I would say they're both kind of like, 50-50, right? We're seeing a lot, and
It
then
depends on where you're at. And
yeah,
again, as the farm owner, the owner of the land moves away from being a farmer, especially if let's face the reality, a lot of land is owned by 70, 80-year-old women. They
yes,
don't want to deal with marketing a crop. They don't want to
right,
deal with the inputs. They just want that nice check. And a lot of those people are also willing to discount a little bit. You know, they're just saying, hey, I don't have to have the hassles, especially if they have a long-term tenant. They're not necessarily looking for top dollar. And then you have other people out there that, every year that land or it's going to come up for an auction bid on it. And,
yep,
they're going to try to get a 3-year lease at $450 when the average in the area might be 350. So, you just got various landlords
yeah.
and not that any of them are wrong or right. That's just the reality for that particular landlord.
Yeah, I think the moral of the story here is it depends, right? Depends
Mhm.
on basis. It depends on, yeah, yeah, how
Every question you ask me, you can automatically assume the answer is it depends.
that's
So
the
yeah,
legal disclaimer, right? It
yeah,
depends.
exactly.
Okay, you touched on this and you kind of hinted at it because, of what you've seen from a profitability standpoint over the years for your own personal, and I'm sure you've seen that with your clients you work with too. But okay, we've got this very, I mean, granted, we've seen some bumps in the commodities, right? I was just with a group yesterday, actually, in central Iowa, and they were happy that soybeans have gone up, right? So everybody
Yep.
was, there was
Yep.
there was some, every time there's a bump in the market, there's optimism. We are the most in agriculture. We are the most optimistic group I think ever to walk the face of the planet.
Yep.
So, but when you're looking at the structures of these agreements and this difficult, ag commodities market, is there anything that you can share? Like, how should someone look at that, right? I know we talked about the personal, but like if you're looking at it from a pure commodities standpoint, where would you like say, you know what? You should probably look at maybe this type of an agreement from a CPA standpoint, both on the tax savings that you get, the 20% advantage, all those things. What would you recommend in a tough ag?
It depends if we're talking to the farmer tenant or if we're talking to the landlord. If we're talking to the farmer tenant, I think he or she would prefer some type of crop share because, hey, I'm going to share in the ups and I'm going to share in the downs.
Okay.
Now I think we are starting to see more toward that flex arrangement where the sort of the floor is lower than a normal cash rent, but
Yep.
then there's a potential for the landlord to go above the average in the area. So
Yep.
I think we're definitely starting to see more of that. From a tax standpoint, other than the 199A, and I typically don't view that as a major hurdle. From a tax standpoint, I don't care. I mean, I guess if I do care about farm income averaging, I want a crop share. I want a crop share arrangement. But other than that, as far as being able to deduct certain items on the farm, if I'm in the Midwest and I want to put in tiling, we
Yep.
now have 100% bonus depreciation. Does not matter if I'm a cash rent landlord, does not matter if I'm a crop share landlord. I'm able to take bonus and completely deduct it. Now, under the current rules, I may not be able to take section 179, but that's really not an issue because bonus, we're automatically getting 100% bonus. Now that's at the federal level.
Yep.
Every state's got its quirks. Minnesota's got an add back for bonus, but they allow Section 179. So that could be interesting in Minnesota.
Right.
California doesn't allow bonus at all, and Section 179 is only 25,000 is the limit. So yeah, when I'm talking, it's really going to be more on that national level. If I know certain states, I'll bring it up, but that's just where we're at.
Gotcha. Well, we have a question. Okay, so do tax benefits differ at all for a landowner if they are receiving straight cash rent as opposed to cash rent with a bonus, like we were talking about, flex?
Yeah, those are
Potential.
typically going to be treated as a cash rent, whether it's a flex lease or a cash rent. From a tax standpoint, they're probably all going to be treated as a cash rent. They're not going to be treated as a crop share. It'd be you could maybe structure it where it'd be a crop share, but it'd be difficult.
Interesting.
And so again, if you have expenses related to that land, you're putting
Yep.
in tiling, you're putting on a pivot,
Yep.
for the irrigated ground and so on, you're going to be able to deduct 100% of that. That's there whether you're a crop share, it's there whether you're a farmer, it's there whether you're a cash rental. So I wouldn't say there's material differences other than farm income averaging. That's probably really the only difference between crop share and either a cash or a flex rent.
Okay. Well, that's good to know. No, that was a good question. Okay. So every time I go to these meetings and see they're always talking about I'm going to kind of switch gears just a skosh here, but not too far off. These I keep seeing these benefits to on the grower side mainly. We'll switch kind of over to the grower side. We've been talking both sides of the fence here, landowners and growers. But as growers continue to, look at new ways to become, increase profitability, become more efficient, there's these R&D tax credits that are out there. What's your thought of them? How have you
Yeah,
seen them
and actually
leveraged?
we had a recent tax court case about a month ago that really was a win for farmers overall. It was a
Okay.
poultry case. Now, for the taxpayer in the poultry case, maybe it wasn't that great of a win because they lost some of the credit because of sloppy work on the provider of the report. But really, this tax court really reinforces that farmers that are out there, they're testing a new hybrid, they're testing a new fertilizer or a new way of applying fertilizer. They have all this data. They're trying to do pest management and so on. I think before a lot of our thought out there on an R&D credit was that you had to have a test field, and
Yep.
if you only have a test, let's say you're farming 5,000 acres and you got this test field of 100 acres. Well, your cost on 100 acres isn't very much.
Right.
But your cost on 5,000 acres of a new hybrid and a new chemical or
Yep.
a new way of doing it can be fairly substantial. So a 5,000 acre farm, if we're looking at the test plot, maybe they qualify for $100 credit. I mean, I'm sort of exaggerating.
Right.
But on a 5,000 acre operation that's really testing out those new hybrids, you're looking at a $50,000 credit,
Yeah.
which is material.
Yep.
Now, your cost of getting that credit, is going to range on the low side, maybe 15% up to 30% on the high side. And they're going to want that money up front.
Yeah.
So you got to make sure you actually owe taxes. If you don't owe taxes, that credit really doesn't help you that much.
Oh, that's good to know. Yeah. Yep.
And then the other thing you got to be careful on, the perception is, hey, I got a $50,000 credit this year. That means next year I automatically qualify for a 50, and the year after I automatically qualify for 50. No, this is a credit based on your increasing research and development expenses.
Gotcha.
So the key is you want to have a very low base, what we call base years. We want to have low base years where you hardly did any research and development, or at least you can report that, and then have a spike, and then maybe go back to not so much, and then wait a couple of years and then do another report. So don't be counting on this large deduction because you're trying out a new hybrid every year. That's not going to get you that big of a credit. So so the R&D, it's becoming more and more popular for farmers. There was a big push on R&D credits back in the 90s, and I would say late 90s, early 2000s. IRS came in and basically wiped them out. I mean, I know out in the Pacific Northwest, we were doing R&D on apple warehouses left and right, and those all
Right.
got basically nixed by the IRS. Well, since then, including this recent court case, the IRS has lost. So
Okay.
I think we definitely are in much better shape from a tax court standpoint, from a court, and also there's been some changes in the code and so on. So I think we're fine on that.
Okay, good. Good to know. One quick point of clarity. So you talked a lot about like hybrids, feed, those types of things. Does, one of the questions that I have in my mind when you were going through that, so does would like technology that builds efficiency into the farms, would that qualify? Like maybe you put something on a new tractor that, helps you with your, well, let's just say like See and sprays and those sort of things that are really trying to save you from an efficiency standpoint. It's a
Typically,
software.
that type of expense does not qualify.
Okay.
Your key expenses are labor, a portion of your labor, which can be difficult to
Mhm.
allocate, but
Yep.
labor, your supplies, the inputs,
Okay.
that's going to be the big thing for farmers. And then if you hire a consultant to help you with the R&D, I mean, not the report itself, but you have some outside consultants that come in, like the local cooperative charges you money to
Yep.
develop this plan for the hybrid, that type of stuff.
Okay.
Those are the three key expenses. But if you're buying a piece of hardware to put on a sprayer for, like you say, seek and spray, that R&D was done by the manufacturer. That's who
Okay.
really gets that
Benefit.
credit. It's
Okay.
not the farmers. So
Good to know. All right. Yeah. Well, that cleared it up. All right.
yeah.
So I don't see any more questions. We're going to kind of move on from tax. I think we've done a pretty good job of explaining the tax considerations for landowners, growers, leases, what you're seeing in the industry. We talked a lot about, one of the sections we're going to move to is like legacy, right? And so, as we see these future generations, carrying on, not only for the landowner, but for the grower or the farmer himself, or their
Yeah.
selves. One of the biggest things we hear is, how are we going to continue to leave this legacy, right? And legacy for me is something that carries on for generations and generations, because that's what their predecessors did. The a lot of the farmers, now some of them have built their own businesses, which is amazing, but also they've continued to build on what they've been left from a family legacy standpoint. How can through a seat from, we talked about the partnerships and stuff and having those people in your universe. How can you as a CPA help farmers think beyond that next harvest, think beyond that, that next, how do you analyze and help them with that planning for the
Yeah.
future? Their legacy is what I'm trying to say.
Well, and there's both what I call sort of the number crunching side, the estate tax potential liability, gifting, and so on. So as a CPA in conjunction with the attorney and their financial advisor, I view it as a team. What I hate is when I'm doing something, the attorney's doing something, maybe a financial advisor is doing something, we're all doing it separately, and then nothing gets done.
Right.
So we like to have it as a team. So that's sort of the number crunching side, where we as a CPA, and sometimes we CPAs tend to be very number orientated. We're not necessarily, I don't want to say this, hopefully I'm not that way, but we don't really like to deal with the touchy-feely stuff. Let's
Sure.
be honest.
Yeah.
And I've dealt with that a lot. It's not necessarily my favorite thing to do, but it's probably my most important thing to do, is the touchy-feely stuff as
Yeah.
far as helping that farm family. Do we have, is everybody in the right seat in the bus, so to
Yeah.
speak? Are we able to help them understand, do you have enough revenue, enough net profit to bring in that next generation?
Yep.
If you don't have enough net profit, what are the options to create enough extra net profit? So
Yep.
that's something that we can certainly help with. Another thing I think that most farmers don't do, that I try to do with a lot of my farmers, is help them determine, understand their deferred tax liability. Most farmers, matter of fact, I have a saying. I say there's 3 genetic chips that farmers have implanted at birth. Number 1, thou shalt buy as much farmland as you can during your lifetime.
Right.
Number 2, thou shalt buy as much green paint, red paint, yellow paint. I don't care what color equipment it is. You're going to buy. You're going to buy as much as you can. And then number 3, which is probably more important, more prevalent, thou shalt not pay taxes.
Yeah.
So they do a great job at deferring, almost too good of a job.
Right.
But they don't understand, hey, when I retire, I've deferred $2 or $3 million of grain. I've deferred, I've deducted $2 or $3 million of equipment, because these days a big farm is not, $1 million, $2 million of equipment is not a big farm these days.
Drop in the bucket, right? Yeah. Nowadays.
So, and they've been used to paying 10 or 20,000 maybe of taxes, maybe 30. And I tell them, well, 4 or 5 million, you're only going to owe $2 million. And, that, whereas if we plan for that, understand that there are certain options. We have a couple options that we can do to continue to defer, reduce. We're not going to eliminate.
Right.
Well, there's one way to eliminate. There's always one way to eliminate tax problems for any human, and that's you die. If you die, we've eliminated the problem. But typically my clients and myself, I don't want to hear that. We know it's going to happen,
right?
But we really don't want to have that to be our tax plan. Although the reality for a lot of our farm families out there, their tax plan is, mom and dad, we're waiting for you to pass away because we can't afford to pay this tax.
Yeah.
Whereas if they'd been managing this tax liability during their lifetime, it would have been much easier potentially to eliminate that tax. Matter of fact, another saying I have is working capital you've paid tax on is your working capital. You can do whatever you want with it.
Yep.
If you haven't paid tax on it, it's either Uncle Sam's or it's the bank or a combination of both. So
when should they start that process? Let's say if I'm
the day they start farming.
Okay.
The day they start farming.
Right. Whether you're just starting out or wherever you are in that life cycle.
Yeah. And your succession plan should start before you have kids.
Yeah.
You and your spouse, typically it's a wife, but a lot of females are the primary farmer now.
Yes.
So you and your spouse should have a discussion. What is our long-term goal for this farm? If we have a farm, is our long-term goal is we really want our kids to farm, or a lot of cases, and this is becoming more and more true, we don't want our kids to farm if they don't want to farm. That's just setting them up for failure. We want them to decide what they want to do. There's a firm belief now that they should go out and work, 3 to 5 years off the farm. I'm a believer in that.
Yeah.
Actually my two oldest boys, I have 4 boys, none of them are farmers, but my 2 older boys started as CPAs or started at Price Waterhouse, PwC, and neither one of them are in or do any tax accounting or accounting at all anymore. And I was thankful for that, because my oldest son kept saying, hey, I want to be a partner with you, Dad. And I'm like, go out, find you really want to do this, and they found out, this isn't what they want to do. So.
Well, that's good. That's really good advice. Now you hit it on it. So you said it was one of the chips, so I'm going to pull it out of. Okay. So and I get that. I mean, I like equipment myself, and I like having neat technology around me. So if they're going to expand, right? And I think everybody has that mindset, especially in agriculture. How should they leverage Paul? How should they leverage their CPA?
Well, I mean, again, let's
evaluate that opportunity or those opportunities, whether it's technology, buying land, maybe buying a series of convenience stores. I don't know. It could be all those things, a rental properties and those sort of things.
Well, I'm a firm believer. I call it, other people use the same term, 3-legged stool. So on a stool, if we only have 1 leg, stool's going to fall over. If we have 2 legs, stool's going to fall over. If we have 3 legs, you can sit on it.
Yep.
And most farmers, their leg, when I talk about legs, the 3 legs are land, or farm assets, land, and so on.
Yep.
Non-farm assets, you brought up a convenience store, mini storage, whatever it might be, and then retirement assets, your 401k, your SEP, your IRAs, and so on. And they tend to really build up that farm leg, and the other two legs might be a toothpick. Another thing that I don't think farmers necessarily understand the value of a retirement plan isn't necessarily for tax reasons. Yes, we get a tax deduction and so on. Farming is a very, how do I want to say this? If farming is a very dangerous business. And a matter of fact, my dad flipped a combine, didn't kill him, but it was close.
Right.
These days with semis and so on and so forth, you're just one wreck away from being sued and potentially losing your farm.
Okay.
Whereas if you put $1 million or $2 million into a retirement account, we sort of call this the OJ defense. If you put $1 million, $2 million into a retirement plan, creditors' bankruptcy cannot attach that. So you can, that's how OJ basically was able to play golf for the rest of his life.
Repeat that for me one more time, because I missed that.
So if you put $1 million, $2 million, or if you have $1 million or $2 million in a IRA, now
Yep.
IRAs can have a limit, but let's say a 401k and so on.
Right.
And it's worth $2 million, and you get sued and you lose everything on the farm. Now, we don't want that to happen, but
No,
in the worst case,
That's
you lose
worst
everything on the farm and you have $2 million in that IRA or in that retirement account. You can pull out $100,000 and live on it, and they can't get $1 of that money.
Gotcha.
So that's why I think if you start young, put as much as you can in there, even if it's a couple $1,000s.
Yep.
And then another $5,000. Also, Social Security. A lot of farmers I talk to, they view Social Security as a tax. They don't want to pay Social Security. I view Social Security as a great investment.
Yep.
Now, we don't want to maximize it. We don't need to be paying Social Security every year at the maximum, but there's a bin point. It's about $15,000 of annual income based on today's dollars. Your rate of return, especially if your spouse doesn't work, doesn't get paid for working outside the home. That's a better way of saying it.
Right.
And so on. You build that up. Your rate of return, if you retire, let's say it's 70, your spouse is at full retirement age, and you guys make it for a minimum of 20 years, you have a compounded 25% rate of return. Even Warren Buffett never had a compounded rate of return of 25%. So instead of eliminating Social Security or paying full board Social Security, I like to see you optimize Social Security. And for me, that's in that $30,000 to $50,000 range of income. Now, if your spouse works outside the home and he or she is maximizing their Social Security, then I'm all for eliminating Social Security on your side, because remember, you're automatically going to be bumped up to 50% of your spouse's full-time retirement age benefit. So those are things that we look at.
That's great.
So
That's great insight. That's great inside information. That's great information. Yeah, that's really something to consider. I'd never even thought of that.
Yeah, because I have farmers. They set up C corporations and they rent the land over to the C corporation, because that rental income is not subject to self-employment tax. And then instead of taking a cash wage out of the C corporation, which would be subject to FICA and Medicare and so on, they take a commodity wage, which is not subject to any payroll taxes. And that's what they do their whole career. And then they get ready to retire, and they've struggled to make a living. They have a little bit of land, but they look at their Social Security statement, says they're going to get $172 a month, if that. Right. And they're like, what do I do? Well, if you're willing to pay in, a couple $100,000 of income, we can certainly fix that. But if you've been doing it all along at a level of about $1,000 to $1,500 a year in today's dollars, 30 years ago it would have been $300. You'd be at that level. You could have $1,200, $1,500, and your spouse would have another $600 or $700 at a minimum.
Yeah, that's great advice. I had never thought of it from a farm perspective as well. That's fantastic advice. Yeah. Well, hey, we're getting down to time. And like I said, I like to keep these really concise. And so I kind of want to finish up with, unless I don't see any other, chats here yet, but certainly if you do have one, just feel free to put it in there. Of course, we're a technology-based company, right? What we're trying to help growers, keep that land in their control, right?
Yeah.
And, pass that from a legacy standpoint, be able to pass that to that next generation of, you know, daughters, sons, nieces, nephews, whoever's going to take over that, and build a solid relationship with the landowners, because we know that there's just more and more vacant land ownership. That's what our
Yeah.
technology is doing, right?
Yeah.
And so, from your perspective as a CPA, is there anything that you're seeing in the industry that you can share that's helping with some of these challenges? I know a lot of it has to be belt buckle to belt buckle with someone like yourself, but is there
Oh,
things out there
yeah.
that you're seeing that, or your CPA and your finding? I like how you said it's important to have everybody in one room, right? And I've seen some really fantastic meeting rooms that some of these growers were, partnered with and have, we're blessed to have as customers. But, what are you seeing any technologies out there that are
Oh yeah,
helping?
no, we're
And maybe could
technology
ours
such as
how could
yours.
ours help? Yeah, how can
Yeah,
ours
yeah,
help?
yeah. So, uh, you know, farmers are not very good at paperwork. Let's be honest. They're
Yep.
not. They don't like it. I don't like it myself. I'm a CPA. I don't like paperwork.
Yep.
But technology has made paperwork so much smoother. Or if you utilize technology, it has made paperwork so much smoother. I mean, I have a scanner right by me right now. I'm touching it as we speak. As soon as I get an invoice, I scan it in there. I don't want it. Now you'll see some paper here, but I don't want to have paper anywhere.
Right.
Now some people, they view it as being, well, it's in the cloud and people can access it and so on. I mean, the reality is probably the NSA is listening in on our podcast as we speak. So, I mean, I don't know if there's anything truly private anymore.
Right.
But, and the other thing, hey, if I have paper in my house, and my house when I was a kid burned up when I was 8 years old,
Good
that
point.
paper's
Yep.
gone.
Good point.
The
Yep.
cloud, there's multiple redundant backups. Now, if you delete it, that's your problem, but there's
Right.
multiple redundant backups. I use AI a lot. There is a specialized tax research software now that I utilize. It
Yep.
helps. Now, is it always right? No. Is it better than it was 2 years ago? Oh yeah, it's substantially better. Is it
Yeah.
better than it was a year ago? Substantially better. Is it better than 6 months ago? Yes.
Yep.
And will it be better a month from now, and 6 months from now, a
Yep.
year from now? Yeah, pretty soon when I ask it a question and I look at the source material, and of course it's helpful. I know a lot of the stuff up front
Right.
anyway.
Right.
It's going to be even more accurate than me and you and everybody else.
Yeah, for sure.
People
AI
say
is.
that's never going to come. It's going to come.
Oh,
Now,
it's
as
coming as
far
a
as
tidal wave.
interpreting it,
Yeah.
it still requires us humans to interpret it,
Very
to
good.
review it, to utilize it. But as
Very
far as the actual research and the speed it does it,
Yep.
it is, I'm a firm proponent of using it.
Yeah.
Now, other technology, we're going to have, and I'm not an AI expert, but I'm getting better at it. But, we have certain agents, the AI agent that's going to be able to take mundane tasks that we used to hate. We're going to take invoices, we're going to scan it in. The agent's automatically going to know where to put it into Xero or QuickBooks Online or whatever it might be. We're not even going to have to even think about it. It's just automatically going to do it for us. And then at the end of the year, you're going to get the 1099s from the government. You're going to get a 1099-G from or Gov from FSA and so on. You're going to get a 1099 PATR. You're going to get a 1099 NEC and so on. It's going to take all that stuff and it's going to look in the system and it's going to match it up and it's going to take half a billionth of a second to do that.
Yep.
Whereas we'd be fumbling around for a couple hours trying to figure that out. So now, is it perfect? No, but am I one of those type that want to go back to, when I started, this is how old I am, Ron, but when I started, my first CPA firm had just bought an IBM PC with 2 floppy drives, not hard drives, 2 floppy drives.
I haven't heard that for a while. Floppy drives.
And it had a green monitor. It wasn't an
I
amber
remember
monitor.
that. I
Monitor.
remember those as well.
It had a nine dot matrix printer.
Yep.
And it cost like $8,000.
Yeah.
And then we bought a fax machine that, I'm not kidding, was probably this wide and this tall, and it cost like $4,000. And it had that weird paper that you hated.
Yep.
I do not ever want to go back to that.
No,
Plus,
we're so glad we
on
advanced.
business tax returns, I was actually having to handwrite the return, and then we made a photocopy of it. You
Yeah,
don't want to see my handwriting. So,
right.
but
Yeah.
yeah,
Yeah, so
no,
like,
technology. I am so looking forward to the next 5 or 10 years. You know,
yep.
I'm older, but it's going to make my life so much easier.
Absolutely. We all want time back with important things like our family and,
Yeah,
exercise and all the stuff that, we need to stay healthy as humans. And so,
yeah,
one of the things that, I guess from what we're seeing is I'll share is, because all of the land, the majority of the lease land or all the lease land information is in there with the contacts, payments, all those sort of things. Um, can that help in the, when, growers get audited and those sort of things? Would that be beneficial from a CPA perspective to have that in? You kind of alluded to it, right? Everything's in
yeah. So
place.
yeah, if we have an auditor that, hey, you're a crop share owner, I don't see a written lease here.
Right.
You're trying to take farm income averaging. Yeah, if you can just simply go to a site, hey, here's the lease, here's a copy of it.
Yep.
Hey, it's signed.
Yep.
Easy.
Yep.
Whereas, now where did I stick that lease?
Yeah.
Where is it? Does it have a
Right.
big coffee stain on it? That type of stuff. So uh, now the reality, I'm going to tell you, Ron, the reality of farmers getting audited is fairly low right now.
Yeah.
I think with this administration, they've gutted the IRS, they've sort of gutted the Farm Service Agency a little bit, the local offices. Over the next 3 years, you're not going to see much in the way of audits,
Yeah. Well,
but
that's good to hear.
it's going to swing the other way. We know it
Yeah,
will.
yeah, it's always a pendulum for sure. And well, yeah, I mean that, and I think that's important too. And we talked earlier about leaving a legacy, and what we hear routinely is, I need all this my 1099s in one spot. I need my land information in one spot, and that's what they're
Yep.
also leveraging, our technology to do because when the daughters step in and the sons step in, well, they're not going to do the filing cabinet thing and they're not
No,
going to do the
no,
three
yeah.
ring binder thing. And
They
guess
didn't grow
what?
up that way.
And guess what? They want to see it on the phone,
Yep, yep.
right?
They grew
And
up
so,
on the phone.
yeah. And
So,
so
yeah,
it's like, and everything's on the phone, right? We have. So it just really helps from a legacy standpoint to have all that in there. So
yeah.
yeah, I think that's fantastic. Well, Paul, anything else that you'd like to share that you're seeing? You've been out hitting the road. I'm sure you've talked to a lot of people. Any golden nuggets that you want to share with the audience?
I guess my only golden nugget, it's probably not a golden nugget, but I'm actually optimistic that I think 2025 might have been the worst. I think 26 is going to be better than 2025. Now that that depends on where you're at and what farm you are and whether you got your inputs all bought. We're
Right.
having a little bit of a bump here on fertilizer and diesel and so on. But I'm pretty I'm hearing more cautious optimism than maybe I heard a year ago.
Good.
Now that's mostly in the Midwest. I haven't been down to Arkansas or that area. I'll get down there later on. But
Okay. Well, that's good to know. Well,
yeah.
hey, thank you so much. Where can folks find more information out about Paul, your blogs, all those things?
Yep, yeah. So the blog is the best spot to go. I tend to blog every day. It's at farmcpareport.com. Now it is subscription based. It's a little bit over $500 a year if you pay
Okay.
for an annual, but there is a fair amount of free stuff on there. Matter of fact, I think my post yesterday was one of the free ones. So I try to do 3 or 4 free posts a month.
Yeah.
So
Yeah. Very good. Yep. Very good. Well, and for us, for the listeners, if you need to find more information out about Oaken, you can go to oaken.com and explore how it helps you, digitize those leases, manage those leases, the auditing process, the legacy process that we talked about, building those relationships with those landowners. Because, again, I think, there just needs to be more awareness brought up about it. And
yep,
I'll share a quick story, and then I'm going to just give you a final thank you. One of the things that we hear, or I hear a lot when I'm talking to folks is, yeah, we've had this ground for 20 years, 25 years. We're good. We have a great relationship with those. But I would encourage everybody that's on the phone to think about what are you going to do for the next 25? What does that ground look? Is that ground still in your control? Can you put a plan as part of your succession plan like you're helping with and others are helping with? I think that needs to be put into the talking points of how are we going to, what are we going to do to proactively to make sure we keep that land? And with our technology, you can certainly do that because it spells out who that next generation is, or you can spell out who that next generation is and begin sharing things digitally and sharing things. And so I think as leaders in the industry, we really need to start talking to folks about that because
Yep.
it's going to help minimize that disruption, if that makes sense. I think that's going to continue to occur. And
Yeah.
if you look at the
Well,
US.
I was talking to a farmer about a month ago, and he was farming about, I think, 1,300 acres from one tenant, or I mean, one landlord,
Right,
and the landlord sold, and he lost all the acres. So
right,
he's got a little bit of his own acres, and he was getting ready to retire and didn't have kids coming back, so
yep,
wasn't fatal or anything. But just think if you were trying to bring in the next generation,
yep,
suddenly that land's gone.
yeah,
So
yeah,
we
yeah.
don't want that to happen.
No, we do not. We want this to be the most vibrant industry and maintain, be the showcase the best industry that it really is in the world, to be quite
Yeah.
honest. But
Yeah.
well, Paul, I always end these the way I start them, on the knowledge and time. We at Oaken and all of our customers that are here and probably going to listen to this over and over again when we post it. We are so grateful for your knowledge and your time that you've spent with us. And
No
so
problem.
again,
I enjoyed it. I always like talking farming and taxes.
and you did a fantastic job with both. So thank you for that. And everybody else, be safe and have a great day.